The Wealth Hackers podcast is a podcast where we teach people how to invest their money efficiently and not lose their capital while gaining maximum returns. It is important to note that anything you hear in this podcast is for research purposes only. You are supposed to consult your financial advisor and do your own due diligence before you make use of it.
Right. Let me start by introducing myself. My name is Daniels. I'm actually the host of the Wealth Hackers podcast. The Wealth Hackers is a group of people. We teach people how to invest in Africa and Nigeria. So what we do is we bring this community together. So we talk about investing in the stock market, cryptocurrencies, and we teach people how to manage their finance, because the stock market is like a wealth creation machine. So what we do is we try to introduce people from Nigeria to this wealth creation machine, because a lot of people from this side of the world don't really know much about that. So that's what we do. So can we get to meet you?
Yeah. Thank you for having me on the show. My name is John Rotonti. I'm a senior analyst at the Motleyfool on our investing team. I'm also the head of our investor training and development.
Yeah.
And the co-host of a few shows on Motleyfool Live.
All right.
I co-host the morning show and I co-host My Investing Life.
Wow. Okay. That's fantastic. Actually, we had that was about 2 months ago. We had Brian Farrell here on the program, and it was it was such a fantastic moment. And I know this is going to be a fantastic moment too. Okay. So let's get right into it. Can you just give us a little background? How did you get into investing? How did you start investing?
I was 18 years old or 19 years old, freshman in college. I didn't know what the stock market was. I didn't know the value of a dollar. I didn't know anything, Chubby. And I went to school and I realized that my parents had gotten into some financial trouble. And so I was trying to think of ways that I could help them out. I didn't know anything. And I went to the library and I found a book by Peter Lynch called One Up on Wall Street. And that book changed my life because it made investing seem simple to me. The idea that you can invest in things that you see every day and that you experience every day, whether it's going to the mall or a restaurant and seeing what stores or what restaurants have a crowd, which businesses are building a lot of customer demand. And so this whole idea of invest in what you know by Peter Lynch just set me on a lifelong path. And ever since I was a freshman in college, I've been trying to learn as much as I can about business and investing. I read all the Peter Lynch books.
Wow.
After One Up on Wall Street, I read his other two books, Beating the Street and Learn to Earn. And then I read all of Warren Buffett's letters and all of stuff on Charlie Munger. And then I started to spread out. I eventually went and got an MBA.
Okay.
So my master's in business. And then I went to New York, spent about 5 years working in New York. And then I eventually ended up at the Motleyfool. And I've been at the Motleyfool for 7 years.
Wow. Okay. So it's actually fantastic. So how do you find your experience at the Motleyfool? A lot of things. We are learning a lot from you guys because your articles and a lot of our members are actually subscribed to the Motleyfool. So how has the experience been with the Motleyfool?
The Motleyfool is it's been a life-changing event for me. It's probably one of, if not the most important and impactful things to happen to my life, because the Motleyfool treats us so well. We have amazing benefits. Our healthcare our healthcare plan is top notch, but we also have unlimited vacation, for example.
Yeah.
Now no one takes advantage of that. We still have to get our work done and stuff like that, but we have unlimited vacation. We have a really supportive and collaborative work environment. So it's just a great, rewarding place to work. And of course, the best thing about it is I get to learn about all these businesses and all these stocks from my colleagues, because as one person, I can only cover so many businesses myself. Yeah. But as a team at the Motleyfool, we cover, it's over 500 companies, I believe. It's a lot of companies. And so I can never do that by myself. So I get to learn about all these great businesses from my colleagues, which is just, it's eye-opening. It's fantastic.
All right. That's good. Oh, let's just dive straight into your investment style. I went through some of your tweets. They are very interesting. I learned a lot from your tweets. So let's just, for the benefit of the listeners who don't really know you very well, So what do you consider yourself? Do you consider yourself a trader or an investor? And what is your investment style?
Yeah, thank you, Chubby. So I'm the ultimate version of an investor if we define investing as not trading a lot, because I only open my brokerage account 2 or 3 times a year. And one of those times is to get my tax documents to send to my accountant to do taxes at the end of the year. I almost never buy and sell stocks, Chubby. For me, it has to be, are you familiar with the Warren Buffett 20 punch card analogy? So Warren Buffett says, imagine each of your investments is one punch on a 20 punch card, and you only have 20 opportunities to buy stocks in your lifetime.
Yeah.
I almost approach it like that. For me to buy stocks, it's got to be what I think is just an unbelievable opportunity, not just a good opportunity. And so my gut has to tell me, I feel it like inside my gut, it has to tell me this is a once in a lifetime generational opportunity to buy stocks. And so that's when I do my buying, usually when the market gets crushed. Because what happens when the market gets crushed, everything falls. All correlations go to 1, everything falls. And so when everything falls, you don't have to worry about why something fell. You can buy the best businesses in the world, the best businesses of our lifetime, but you know that it's cheap just because everything has fallen. It's not a company specific issue. And so I would say my investing philosophy is I invest in high quality growing businesses. So I insist on growth. They have to be growing, but I also want them to be profitable with high returns on capital, really strong balance sheets, and management teams that take a stakeholder approach to value creation as opposed to just boosting short-term profits for shareholders. I want them to look at their whole ecosystem of constituents, from their customers to their employees to their suppliers to the communities in which they operate, and then the planet as a whole.
Wow. Okay, that's good. I actually wanted to ask a series of questions, but when you say you buy at the low, I can't just resist going straight to this question. How did you handle the downtrend? Because a lot of people didn't buy. A lot of people wanted to understand the pattern the market was moving before they could make some investments. So what did you do during the downturn? Were you like buying more of your convictions, or were you holding out?
Yeah, great question. I'll answer that in a second. I just want to clarify one thing. I hope I didn't imply that I buy at the absolute low. I don't know how to time when the absolute low is. I don't know how to time the bottom. What I do try to do is buy when the market has fallen significantly. Now, the market may have fallen significantly. I may buy some stocks and then it may fall more. So I don't always time the low, but I do try to buy when things have fallen a lot. When things fall a lot, Chubby, that's when I get excited. And so in March of, we can go back further. We can go back further than that. In 2008, 9, and 10, I was buying a lot of stocks because it was the global financial crisis, the GFC, and the housing crisis here in the United States. And so at one point, the S&P 500 fell 50%. So I was buying a lot of stocks. It was a generational time to be buying. And then I got lucky again in 2011, 1 year later, because 2011, if my memory serves me, that was when the U.S. lost its AAA credit rating on our U.S. sovereign debt. We lost our AAA credit rating. Yeah, it was a non-event really. And the markets freaked out. So I got to buy more. So 2008, 2009, 10, and 11, generational buying opportunities. And then 2013, we had something called the taper tantrum, where the markets freaked out because the Federal Reserve indicated that it may start raising rates. And the market freaked out. Stocks sold off. I got to buy a little more in 2013. And then December of 2018, stocks fell 20% in the last month. I think they bottomed on Christmas Day or right around Christmas Day. That's December 2018. So I got to buy a little more then. And then I didn't buy, I don't think, almost anything until March of 2020, when we had the the COVID pandemic and then the subsequent economic lockdowns across the globe. Economies across the world shut down. They closed down their economies, unprecedented as far as I know. And that really sent the market down faster than it has ever fallen. The market fell 34% faster than it has ever fallen. It took 23 days.
Yeah.
And so I did a lot of buying then. March and April of last year. Since March and April of last year, Chubby, I've only bought one stock. And that was maybe a month or a month and a half ago. So I really don't buy often.
Wow. Okay. Kudos for the investment strategy. So this is really interesting because I like the way you buy. You just have to get a very high conviction, then you buy. Then I just want to ask, how do you actually build conviction? Because a lot of people who talk to will tell you about how they build conviction over time. They buy a little, then after some time, they add more to their position. We have actually met people that say they buy all together at once. So I just want to understand, what is your style to building conviction? Do you only buy when you are convinced, and then do you do like the buy? Do you buy like the bulk quantity at once, or do you like buy little by little over a period? How do you do it?
Awesome. So I have an article. It's titled, "Do you have an investing checklist?" at fool.com. Do you have an investing checklist? And I have my investing checklist free to the world that everyone can see. And it's basically 10 questions, and each question has multiple sub-questions. But it's 10 questions, and I score every company on a scale of 1 to 10. 10 out of 10 is the best you can get. And that framework helps me decide what are my highest conviction ideas. Higher the score, the higher the conviction. But it also helps me with position sizing. And so if I find a 10 out of 10, I'm going to take a larger initial position, a full position, let's call it. Let's call it 3 to 5% of my portfolio. That's just, I'm talking in generalities, but on average, a full position, maybe 3 to 5% of my portfolio. Something that scores well, but I think it's just really overvalued, that I may still take a really small position. And by really small, I mean 1% or even less of my portfolio. It could be a half of 1%. It could be a quarter of 1%. I just start a tiny position. I also start tiny positions in companies that don't score well on my portfolio. They get lows, on my checklist. They don't score high on my checklist. They get low scores, but I still have a gut feeling about them that they're going to score high one day in the future. And so I'll take a small position there as well. I don't just buy a stock once. I usually buy, and then I found out that I bought too early and the stock falls. And so I'll buy a little more when it falls. I almost always buy a little too early. And if it keeps falling, but the story hasn't changed and my conviction remains high, then I'll buy more. But then every once in a while, a great business will get to really weird, strange, low valuations. For example, I think Apple's a really great business personally. And every few years, it would trade down to 10 times free cash flow. That's a 10% free cash flow yield. And so whenever Apple would trade down to 10 times free cash flow, I would just add to my position. And so, I usually buy several times over a span of several years, if that makes sense.
Oh, okay. Actually, that makes perfect sense. I understand that. Now, let's just go straight to, because trading is about buying and selling. Now, let's talk about selling. We understand that you don't buy frequently, but do you sell, and what triggers you to sell? I want to talk about even taking profits, because taking profits is just selling too. So when do you take profits, and how do you even sell stocks at all?
I don't sell frequently either, but I do sell. So one reason I have sold in the past is if the company's management disappoints me. So either they did something illegal or immoral, or they made some strategic business decision like an acquisition that I think just did not make sense. So that's one reason I will sell, is if the company does something that I fundamentally disagree with. on a moral or ethical level, for example, or if management just really disappoints me. If a stock gets too expensive, if it starts trading at a really high valuation and the market starts baking in really high expectations for the future of that business, I don't necessarily sell that. If it's a great business that I think will remain great, I'll hold it because I have this idea that winners win over the long term. Yeah. But Chubby, if I'm looking to raise cash, if I'm looking to find a source of funds to buy a new position, then I'll trade. I'll sell a little bit. I won't sell out of it, but I will trim my larger positions or my positions that I think are just trading too expensively. I will trim them. I'll sell a little bit to raise cash to buy something else that I see as a better opportunity. But I normally don't sell out in that scenario.
Okay, what of when you are actually making profits? Let's say you just opened the position and it's been running up 30, 40%. And you talked about a position being 3% of your portfolio. But this is actually increasing. You know how these things happen. You actually buy, it keeps getting profitable, then it becomes 15 to 30%. Do you do some kind of allocation where you say, okay, this is too big and I actually want to trim it? Or do you just allow the stocks to run?
I will normally allow them to run, normally because I want to find businesses that I can theoretically and ideally hold until I retire, right? Like I want to let these businesses do the work for me. I want to let them continuing to compound their intrinsic value. I don't have to do anything. I just sit back and watch if I'm right about the stock that I picked. Now, I'm not always right, but if I'm right, those businesses just compound over decades, and over time, the stock price will follow the underlying business value that is compounding. So ideally, I'll let them run. But I have something I call the sleep test. If a position has gotten so large in my portfolio that I lose even 1 minute of sleep over it, Chubby, I will trim it down. Honest to goodness, that's my test. So if I'm laying in bed at night, and if even for 1 second the thought crosses my mind, oh, I'm a little worried about how large that position size got. If it just crosses my mind, then I just trim it. And I trim it back until I no longer have that thought in my mind. And so, yes, I call that the sleep test. I don't want to lose 1 minute of sound sleep. And so even 1 minute. And so that's my sleep test. If it gives me 1 minute of discomfort or anxiety, then I'll trim it back just a little bit.
Okay. Oh, that's fantastic. Thank you for that. Okay. Now I just want to backtrack a little bit back to the buying. When you talked about your checklist. So when you get stocks to put in this checklist, what do you normally use to pick out stocks? Do you focus on industry or teams like mid cap, large cap, and small caps? How do you get the stocks that you check on your checklist before you actually get to buy them?
So I would say that I'm market cap agnostic. So I don't care if it's a small cap or a large cap. Mid caps seem like a really good sweet spot to me but I don't screen for that. I just get really excited when I find a good mid cap that I love. And the reason mid caps seem like a good sweet spot is because they're more established than a small cap. So they're maybe not guaranteed, but maybe less risky than a small or a micro cap, but still have more room to run than a large cap. Right? Because all large caps started off as small caps or mid caps. And so I want to find a company that can, with a market cap that let's say it could grow from 10 billion to 100 billion, right? Yeah. It could 10x. I think it's much easier to find a 10x opportunity in the small or mid cap pond, if you will.
Yeah.
And so mid caps are that sweet spot. Less risky than a micro cap or a small cap, but more room to run, and 10x maybe or more hopefully, than a large cap or a mega cap. But I don't run screens, Chubby. I really don't. I don't screen for an industry or or a market cap size or an index or a country. I guess I just focus on companies that meet my checklist. Yeah, and it's I can mention a few of the checks really quickly if you want me to.
Okay, you can go ahead. Yeah.
So the first one is always balance sheet. Always, always, always. Does it have a strong balance sheet?
Okay.
Preferably with net cash, meaning more cash than debt. And the reason is because I see the balance sheet as the structural foundation of a business.
Yeah.
Just like the structural foundation of a house or a building, I don't think you can build a sustainable business over the long term on a weak foundation.
Yeah.
So for me, everything starts with the balance sheet. And if I don't think that balance sheet is sufficiently strong, I move on. So that's like my first line of defense. Does it have a strong balance sheet? And then I want to know if the business is growing organically. I don't really like acquisitions that much.
Yeah.
And if that growth, that organic growth, is powered by a large total addressable market, so a large market opportunity and long-term tailwinds, I look for margins and returns on invested capital that are high or rising.
Yeah.
So they can start low as long as there's an upward trend. So high and or rising. Like I said, I look for great management. I define great management. It's companies that have the 4 C's. This is another framework that I sort of came up with. So these are management teams that are compassionate, capable, candid, and committed. And then there's several other checks, but those are some of my top 10.
All right, fantastic. You mentioned something about SPACs, and I just want to, still on the buy it, I just want to talk about IPOs. A lot of people have said we never buy IPOs because most times when you buy IPOs, it goes up, then it goes down. We saw what happened with the recent IPOs during earlier this year, Airbnb and many of them. Even Coinbase, it went up and it's still going down. So is there any condition that makes you buy an IPO, or don't you buy IPOs at all?
I normally don't, but I'll tell you, I got lucky and I bought Zoom video very close to its IPO. Not on the day, maybe not the week, but very, very close to its IPO. And the reason was because Zoom actually came public. It was profitable on a GAAP basis, like generally accepted accounting principles, real profits. Most of these software-based, I don't know about most, but a lot of these software-based business models that sell software as a service, SaaS, SaaS, that are growing really, really rapidly, they're not generating any profits. Some of them aren't generating any cash flows. And so when I find a fast-growing business like Zoom with a founder CEO like Eric Yuan, great CEO in my opinion, when I find a great CEO at a super fast-growing company with a technology that is really inventive and innovative. They did something different. Zoom's technology, it's based on something called bit rate encoding. And what Zoom's technology does is if you're running on a slow bandwidth internet, it actually helps, it makes it almost speed up the video quality.
Yeah.
So it's designed to work on slow internet. Zoom was. It was designed to work on low bandwidth internet, and it helps improve the speed of slow internet, which is, I think, remarkably inventive and innovative. And so I find a great innovative business, fast growing, great leader that I admire, who was trying to solve an important customer problem, and it was profitable at its IPO. That was the final condition for me that got me really excited, is that it was profitable and fast growing at its IPO. In my opinion, this is sort of maybe contrarian or controversial, but I think that the best businesses in the world, the best of the best, should be both fast growing and profitable. And so when I find that combination, I get really excited. So Zoom is an example of one that I bought at the IPO.
Okay, let me just focus a little on when it comes to industries and maybe technology or not that. Is there a kind of industry you focus on? A lot of people say they want to focus on disruptive technologies because they believe that's where the future of investing is. So do you have some kind of industries that you're focusing on at the moment that you're looking at to invest more on?
Two industries at the moment that excite me a lot are semiconductors, which are basically the components that are powering the digital revolution. There is no cloud, there is no AI, there is no machine learning, there is no video gaming. There is no Internet of Things. There is no automation and robotics. There is nothing without chips, without semiconductors. And so semiconductors would be one, and housing would be two, because I feel like we have, well, this is not an opinion. This is factual. We underbuilt homes in the U.S. coming out of the global financial crisis in 2008, 9, and 10. And so for the last several years, we've been underbuilding by about a third of what we needed to build per year. And it was either Freddie Mac or Fannie Mae, one of the two, recently was quoted in the Wall Street Journal as saying that we have 3.8 million fewer homes than we need. We need 3.8 million more homes in the US. So we're 3.8 million homes short of what we need to satisfy household formation. And so companies I like some home builders, and in particular, I like some home improvement stores like Home Depot, for example, and Lowe's, for example. So I really like semiconductors. I really like housing. And I like different aspects of the digital economy, like payments, for example. There's lots of industries that I like.
Okay, let me just get quick with the ones you've mentioned. Let me just get very fast about it. NVDA actually announced their stock split, and there was like a sharp decline in the stock price. What do you think caused this? That's part one of this question. And then what do you think about stocks like Redfin versus Zillow versus ESPI? Who do you think will win in that space, let's say in the next decade? It's not an advice, but your own personal opinion.
Sure. So I'll talk about stock splits in general. What we know is that a stock split doesn't change the value of your investment at all. So if you owned one share, if we owned one share at $100, we have $100 invested in the business. If it's a 2-for-1 stock split, we now own two shares at $50. We still have $100 invested in the business. So our investment amount, the value of our investment, does not change. This does nothing to affect the underlying intrinsic value of the business. A stock split, zero. Some options investors like it because now you can buy the option contracts for less money because the stock price is lower, and so that is favorable if you're doing a lot of options and derivatives trading. But in general, stock splits, some of my favorite companies in the world have done stock splits. Apple has done a stock split. NVIDIA, I own that one as well. I own both of those. They do stock splits, and I just kind of take it as I don't care. I'm not a fan of them, but they don't disappoint me that much either. Really, I think if I had to nitpick on one thing, I think stock splits make it easier for people to use margin and options and trade in and out of these stocks rather than take a long-term buy well and hold approach. And so, if I had to vote, I would say leave the stock splits at the door. We don't need them, but I'm sort of indifferent. I don't care that much. And then you asked me who's the winner in
who's going to be the winner?
In iBuying, for example. And I mean, well, it's not just iBuying. Zillow and Redfin are sort of vertical market search engines for home buying and renting. It's like a vertical search engine for real estate. And then they also do this iBuying, house flipping as well, which is like, I sort of see that as optionality. But here's the thing, and then Open Door is another one, right? So you got Open Door, you got Zillow, you got Redfin. I don't know who's going to win, Chubby. And so here's what I always recommend to our viewers on Motleyfool Live: buy a basket. If it's a situation where I feel like I have a really strong conviction in the long-term theme. So I have a really strong conviction in iBuying and in the idea of doing online searches and advertisements for the real estate industry, right? So that's just like one more aspect that's moving digital. That's a really high conviction theme for me. But I don't know who the winner is going to be out of that group. And so my advice to people, or my advice to myself, this is what I would do myself, is to just take small stakes in all of them, or two of the three, or three of the three. And so it's a basket approach. On the morning show on Motleyfool Live, every month or every couple months, we try to do a different themed basket. And so we've done like a video gaming basket, because there's so many good video game companies. That's another theme, by the way, that industry that really, really excites me. So many good video game companies that I'm not sure who's going to be the winner, but I know I can pick probably 4 or 5 that have a good chance. And so I'll do a basket. Same with healthcare, we could do a basket. Same with cybersecurity, we could do a basket. So whenever I can't pick one winner, I just try to buy several.
All right.
It's like the easy way out. I'm hedging. I'm hedging my bets.
Yeah.
My bets.
I love the basket theory from actually Motleyfool. I think that was year before last. I was listening to Fiverr versus Upwork, and the conclusion to it that day, I don't remember the name of. I think Brian and who else was talking about it. They concluded that the best way, since the industry like has a long way to run, was actually to like buy a basket of little of them. So I really did that, and actually I'm up much on Fiverr and Upwork. Fiverr is actually growing more than Upwork. Okay, thank you for that. So before actually, because our time is fast spent, because I just want to talk about some of these topics a little bit before we wrap up for the day. I want to talk about the new kid in the block. Just one question. Cryptocurrencies. At a point, because we have separate rooms in the Wealth Hackers, because we wanted to separate the people that are doing the cryptocurrencies from the guys that are doing stocks. We have a fundamental analysis group where we just analyze our stocks for a long time and all that. But you know, when the bullish market for cryptocurrency came, you see people coming from the stock group to the crypto, from the crypto group to the stock group to talk about buy Dogecoin and all that. So I just want to talk about cryptocurrencies. Where do you see it going? Do you believe in it? Do you believe like that the US government will embrace it, knowing that there's a likelihood that this may be detrimental to the US dollar, which is the like capital cash reserve for the world? And where do you see the cryptocurrencies going in the let's say 10 years time?
So I don't know what the U.S. government will do. That's above my pay grade. I've studied cryptocurrencies. I've studied the underlying technology of blockchain to some degree. Yeah. I'm not an expert. Yeah. I don't understand everything. Here's where I am now, Chubby. So because I don't understand enough to have a conviction one way or the other, bullish or bearish, I have not invested in any digital coin, okay? Any coin. But I do have some sort of indirect backdoor investments in crypto because I own a lot of Square and a lot of PayPal. Two of my large, I mentioned digital payments or an industry that excites, or a theme that excites me. And both Square and PayPal are ways to play Bitcoin. Okay, so I'm invested in Bitcoin sort of indirectly through Square and PayPal. I'm also invested in Bitcoin because the Motleyfool, the company that I work for and the company that I am an owner of, we're all owners of the Motleyfool. We bought Bitcoin and put some on our balance sheet. Okay. So I also own some Bitcoin through the Motleyfool and my ownership of the Motleyfool. And then Tesla as well. I own a lot of Tesla, and Tesla has put Bitcoin in its balance sheet. So there's like 4 companies there: the Motleyfool, Tesla, Square, and PayPal. That's my indirect way. Now, whether I think you asked me if cryptocurrencies will be higher 10 years from now. I think some will, and I think some won't. There's a lot of coins out there.
Yeah, 5,327, I think.
Oh my goodness, I didn't know it was that many, but yeah, there's a lot of coins out there. So yeah, I think some will. I think Bitcoin is the biggest brand. I think it's been around for over 10 years, maybe 14 years now. Bitcoin. Yeah. So that one is the one we know most about. It's the one we're most comfortable with. I think that one has a good chance of being higher. I think Ethereum is interesting in that it's a platform where you can build off of, whether it's NFTs or other things like that. And so I think that's interesting. I don't think they'll all be higher. I don't know what the U.S. government will do, but I think it's exciting, and I want to learn more about it.
All right. Thank you for that. That was actually fantastic. I was just going to ask you about Coinbase. What do you think is going to happen? You mentioned Tesla, Square. I was thinking I'm going to hear Coinbase, but you didn't mention that. What do you think is going on with Coinbase, and where do you see it going post IPO, like after everything normalizes a little bit?
I don't know, because I haven't studied Coinbase. I know what it is. I know it recently had its IPO.
Yeah.
I haven't studied it, so I can't give you an educated opinion. I will say one thing that has come to mind is that what prevents other brokerages from offering digital coin trading, from offering the trading of Bitcoin, Ethereum, and these other coins? Like, why can't Charles Schwab do it? Why can't Vanguard do it? Why can't Fidelity do it? So I don't think the barriers to entry are high.
Yeah.
And so I think, like, I haven't studied it yet, but I think that Coinbase is going to see a lot of competition pretty soon. But that's just my opinion now. Maybe that'll change. But I do think it's going to be a competitive space, Chubby.
All right. I'll just take one more question on management, and then you can just tell us where we can find you on YouTube and any other place, your social media handles, so that everybody in the community can follow you. Or when it comes to management, you talked about the 4 C's and all that. Do you think that management that is founder-based and have skin in the game, do they have like an edge over the CEOs that just came in? Do you really check that when you're actually evaluating a company?
Some of my favorite CEOs are not founders. Some of my favorite. So that you can find amazing, incredible, stakeholder-first CEOs that are not founders of the business. But one thing I do like about founders, founder operators, owner operators, and one thing that I think, gets me to focus a little more of my attention on founder-led businesses is that they are long-term focused by nature. I mean, this is their baby. This is what they want to build over their life. Toby Lutke at Shopify, now he's an extreme example of just an incredible CEO, but he talks about building the 100-year business. The 100-year business. And so what I mean by being long-term focused is they're not going to do things to boost short-term quarterly earnings per share.
Yeah.
If it will harm the long-term value creation of that business. They're focused on, they would actually take away from their short-term profits if it means investing in the long-term future, in future-proofing that business. And so that's what I think you get when you get the right founder, is you can get someone that's constantly adapting, constantly innovating, constantly keeping their sights on the horizon, so that they are future proofing their business and making it a multi-decade compounding machine.
All right. I will have a lot of other questions I would have loved to ask, but because of lack of time, I will just end here. I'm hoping you can join us some other time when the broader community, because we do have a daily podcast where we have a community of 2,000 people on Telegram, and we have people joining from Twitter and other platforms too. We do this podcast every week, talk about what's going on in the market, and then we try to discuss all this. So for the viewers, we just want to know where can we find you on social media? Do you have an ebook or something that we can actually buy and read?
Thank you, Chubby. First of all, I'm honored to be on your on your show. You're a really great host. I'd love to come on again if I get the invitation. So I'm on Twitter at JRoGrow. That's JROGROW. And that's the only social media I'm on. I'm not even on LinkedIn. I'm on nothing else. I just try to keep a low profile, but I do publish a lot of articles on Fool.com. So if you just type in John Rotonti, Motleyfool, you'll get a list of my articles. And Chubby, if you want, I can send you some of my articles that have been read the most.
Okay.
And you can share those with whoever you want. So I'm on Fool.com. I'm at Twitter, and I published a book, but there's better stuff out there. I published it back in December of 2013. It's called A Manual on Common Stock Investing. And it's just a really short book. It's like 113 pages, designed for the beginner, beginner, someone that does not even know what a stock is.
Yeah.
But I published it a long time ago, and 8 years ago, and I've learned so much since then. There's better stuff you can read out there. I would recommend 3 books that people start with are Peter Lynch, One Up on Wall Street.
Okay.
Joel Greenblatt, The Little Book That Beats the Market.
Yeah.
And Pat Dorsey's book, The Little Book on Compounding Wealth, or The Little Book on Wealth Creation, something like that, by Pat Dorsey.
Yeah.
I would start with those 3 books, far and away ahead of my book.
All right. We are the Wealth Hackers on YouTube. All the social media handles, the Wealth Hackers. We are on Anchor FM, Spotify, Google Podcast. I'll add a description for your social media handle for all those who want to follow John. Thank you so much for joining us today. I'm hoping to have you soon again. Thank you so much for coming on. And do you have any parting words for our listeners, for the guys in the community and every other one that may see this video?
I would just say that if you're learning to invest, as I am still learning, just like cash flows compound, and just like business value compounds over time, knowledge compounds as well. And so, just read as much as you can about business and investing. Listen to as many podcasts as you can, as many YouTube videos as you can. Attend conferences once we can meet in person again. And wealth compounds in the same way that businesses and stocks compound.
All right. Thank you so much for joining us. I hope to get to talk to you some other time. I'm really grateful that you could join us today.
Thank you, Chubby. Great podcast. Right. I appreciate it. Bye-bye.
All right.